This finance update is brought to you by Trobe Financial, Australia's premier alternative asset manager.
It's great to have your company here on Business Now. Well, as I just mentioned with Alan Oster, the Reserve Bank Deputy Governor Andrew Hauser today, for the first time, suggested we're moving on from the period where the economy was described as being on a narrow path. So if rates rose too fast, we would fall into recession. If they didn't rise fast enough, inflation would stick around. Well, Ed Boyd caught up with Trobe Financial Chief Executive Chris Andrews to talk not only rates, but also the effect of Donald Trump's policies on the markets.
I think it's certainly going to be a rocky road for the next 6 to 12 months. We'll see what happens from there. It's pretty clear, for example, that the US has elected an unconventional president, and what that tells us is that the status quo is no longer satisfactory to the US population. What does that mean? We can expect change. We're seeing that in geopolitics, we're seeing it in trade, we'll see it in taxation policy over time. At the moment in the US, they're very bullish about what that means for the US economy. For a trade-exposed nation like Australia, it is a period where we're going to have to step very deftly.
And your assets in America, clearly with Trump being pro-US and pro-manufacturing, that's got to be a good thing.
Yeah, certainly it's a good thing for our US private credit strategies, Ed. You're absolutely right about that. I'll say this, though. Our view is that part of the US market is absolutely locked in now for the next 20 or 30 years, because whether it's Trump, whether it's the Democrats, whether it's another incarnation of the Republican Party, there is unanimity in the US that they have overlooked Middle America for the last 20 or 30 years, and they've got a 20 or 30 year task to rebuild it. And really, that's what that investment strategy is focused at. So we're feeling, we're politically agnostic there. We feel like there's some just really fundamental drivers that are going to put a floor under that part of the market for many years to come.
OK, turning to Australia, the Reserve Bank's finally cut interest rates, giving some relief to households with a mortgage. Are you expecting any more rate cuts this year?
I'd be hesitant about whether there's more, Ed, and I'd just pick you up on one point. I would really love to change the paradigm that a rate reduction is necessarily a quote-unquote good thing. It points to softness in the economy, which isn't a great thing, and its effects are mixed. Sure, it gives a bit of relief to current borrowers, but it does so at the price of asset price inflation over the longer term, which exacerbates our housing affordability crisis. And for our investors, and for savers everywhere, it's a pay cut. So, the economy is the science of trade-offs, but I think we've got to be careful about putting that in the basket of unalloyed good news.
Yeah, we've seen a few sentiment surveys from ANZ and Westpac over the past couple of weeks saying sentiment has improved since the Reserve Bank cut rates. Are you seeing any signs of sentiment improving?
Yeah, we certainly are. So we're starting to see, places like Melbourne, which have had a really tough year, and there is some bearishness around the Melbourne economy at the moment, I think it's fair to say. We're seeing places like that show a lot more signs of positivity. We noted the house price index showed that Melbourne house prices actually grew in February for the first time in about a year, which is a really good sign for the economy. Again, though, 25 basis points, I'd be a little bit hesitant about reading too much into that just yet. We'd want to see a few months more before we start to lock in a bullish economy for the rest of the year, Ed.
Yeah, I guess, as you say, 25 basis points is not a lot at this stage, but it's the cumulative effect of 2 or potentially 3 rate cuts. Then you'll really see, for example, borrowing power of someone looking to buy their first home improve.
Yeah, possibly. Offset by, as I said before, the potential for asset prices really to get growing, which means people's capacity to borrow increases, but so does the price of the underlying assets. So that's the difficult situation we're in at the moment, Ed. We have an intractable problem with house prices that can't be cured in the short term. It's a fundamental demand-supply imbalance that has to be addressed. So when we think about interest rates, I suppose what I'm saying, Ed, is we need to take a balanced view.
And then from a property investor's perspective, if asset prices are going higher and higher, doesn't it make the investment market a bit less attractive for them?
Yeah, no, that's true. And, private markets do have that benefit for investors where they move out of some of the sort of the geopolitical volatility that can impact the share market and the like in the short to medium term. And so those investors maybe can take a more measured view of medium to longer term fundamentals. And certainly for housing investors, for folks who have housing now, this demand supply imbalance is absolutely a flaw under the value of their assets. So it's a good thing for them.
And how are your clients feeling at the moment?
We're seeing a lot of positivity, Ed, I've got to say. Certainly our investors are investing in force. You know, if you think about a very conservative investor who comes to Trobe Financial, average age sort of 65, they're looking for consistency, they're looking for stability, they're looking for transparency. We've always leaned into that. I think, you know, given all the geopolitical issues that we are witnessing at the moment and just concern about the direction that the world might be heading in over the next 5 years in all parts of the world, really, I think investors do like the sort of stability, consistency, transparency approach that we're taking.
Chris Andrews, CEO of Trobe Financial, thanks for coming on the show.
Thanks, Ed.